Hello everyone. Good evening to all. Welcome you all in the YouTube channel of Oliveboard. So today we have to start marathon of next module, that is module C. Again we will be doing some questions related to module C. Today in the morning we have done its theory part and now we will be doing questions related to all those topics. So let's proceed now. Before moving forward, please confirm me my audibility, every visibility is fine or not. I hope everything is fine. I hope Sure. So let's start the session now. So this is our capsule batch, your last minute revision series. So far we have completed total 5 lectures in our capsule batch and 2 more lectures are there. So for English medium, you can watch my classes and for Hindi medium, you can watch Pradyuman sir's class. Now, first question. Give me the answers and please don't forget to mention the question number before giving your answers. Which one of the following is not a primary approach towards corporate valuation? In corporate valuation, we have different approaches. 5, 6 approaches are there. Now, which among the following is not the approach related to CV? Income approach, market approach, cost approach, or profit and loss approach. So for every question, I'll give you 10 seconds. If you will answer me, otherwise I'll give you the answer. And those who are watching for the very first time, I highly request you to kindly subscribe our channel. Both the channel, the English medium and Hindi medium YouTube channel. And if you like the video, if you feel that sessions are beneficial for you, then you can like this video as well. So in corporate valuation, we have different approaches. We have 6 approaches. Now we have income approach, we have market approach, cost approach, but profit and loss is not any type of approach. Approach means what? If you are purchasing any kind of company. Now, if you are purchasing any company, so definitely you will do the valuation of that company. While doing the valuation of another company, so you have to use different approaches. Which approach you will going to follow for doing the valuation? Either income approach, market approach, stock and debt approach, direct comparison approach, which approach? So that is why different approaches are given to the purchaser for doing the valuation of any XYZ company. PL approach is not one such approach. Now, all these 3 options, the income approach, what does the income based approach says? It says you that in future, if I am purchaser and you are buyer, okay, I want to purchase your company, so I will do the valuation of your company. Now I'm asking to you that what is the scope that your company will going to earn in future, 10% or 20%? What is your future profit? Okay, what is your incoming scenario? I'm going to ask you from the seller's company. So this is what how much money it will make in the future this company. That is income based approach. Clear? Now, with this, we will do the discounting. That is discounted cash flow. We will follow one method in our income based approach. We will do discounting, that is time value of money. Now, next approach is the market based approach. Again, what is the value of your shares in the market? What is the value of similar type of company, the comparable company in the market? So by comparing your company with similar companies in the market, that is market based approach, or you can say that direct comparison approach. Clear? Now, next is cost based approach. Cost based approach tells you that what it would cost to build the business today, means your all assets, what the assets which you are having in your company, what are their present value in the market? What are their value in the market, your assets? That is cost based approach. Clear? So these are the three approaches are there of income, market, and cost approach. Now, next question. Two questions are given. Under the Income Tax Act, which section provides tax neutrality in case of amalgamation of companies? That the amalgamation of companies, amalgamating and amalgamated companies, they both get the benefit of the tax benefit. Okay, but the company should be related to Indian company. It should be Indian company then only. In which section it comes? 80C, 72A, 35D, or 44AB? That is option B, 72A. Now, which among the following does not a feature of discounted cash flow valuation method? Discounted cash flow is what? You have to find the present value. You will do the discounting with the help of discounting factor or a discounting rate. If rate is given at the rate of 10%, then how you will do the discounting? 1 upon 1 plus R. Number of N means the time period. Okay, number of years. So 1 upon 10%, it means 1.10. If you will do equal to, you will get 0.909. So which one is not the feature of that? It considers future cash flows. It is the discounting rate. Yes. It ignores time value of money. Does it ignore time value of money? It considers time value of money. It does not ignore. It considers time value of money. That is option number C. It is not the feature of discounting. Why? Because ignores it is written, but it considers. Now, next. You have to solve this question with the help of dividend growth model. What is the formula of dividend growth model? Tell me. D1 upon R minus D. Or sometimes R is written as cost of equity. So the shares of a company are quoted at 40 per share. Last year, the firm had dividend at rupees 4 per share. So last year dividend is given rupees 4. So you have to find the D1. D1 is what? That is present year dividend. Now required rate of return, that is R is given 20 required. Now you have to find the dividend growth model. So first you have to find the present year's dividend. So how to find the present year's dividend? Growth is what? 16%. Solve and tell me. This is what? This is, you have to find the present year's dividend. Now, what is DO? DO is given 40. 1 plus G is what? Growth rate is given to you. That is 16%. So we can write 0.16. Can we write 0.16? Tell me. 4 into 1 plus 0.16. This is 4. Sorry. Okay, not 40. It is 4. 4 into 1 plus 0.6. Clear? Now, if you will calculate, tell me what is the answer. It is 4.64. This is your present year dividend. Now, how to find present year dividend is 4.64. Now, put the values in this formula. 4.64 upon R is what? R is 20, 0.20 minus 0.16. So if you will calculate, you will be getting 116 per share as answer. Done. Okay. Now, next question. Replacement value refers to the actual cost that can be incurred to replace an asset in its If you are replacing any kind of asset, replace for you need replacement value. Now, replacement value is what actual cost that has to be incurred to replace that asset in that what type of condition you will select. You will replace the asset at its market condition, at its existing condition, or both of them. It is none of the above. In its existing condition. Now, next question number 6. Which of the following valuation is best for evaluating an owner-occupied non-income producing residential bungalow? If you have a bungalow, that is the owner has occupied that bungalow, it is non-income means from bungalow you are producing no any kind of income. It is not for business purpose, it is for residential purpose. Now, which technique you will use for evaluating the value of that bungalow? Discounted cash flow, direct sales comparison, profit, or hypothetical. So we use direct sales comparison method. We compare the similar type of bungalow and then we do the valuation. Now, what is terminal value? Terminal value means what? We say now the term. Term means the last, the final. So it is what the value of a company's asset at the end of its useful life. Now next question. 8. The worth of an asset can be determined by analyzing its price in relation to the comparable assets. Now, in terms of common variables such as earnings, cash flow, book value, or sales, you are valuing that company with the help of comparable. You are following the comparable method, and in that comparable method, you are comparing the earnings, you are comparing the cash flows, you are comparing the sales, the shares. So this is what? What type of valuation is this? Discounted, relative, contingent, free cash flow valuation. If you are comparing the assets, that will come under relative. You are finding the company that is working in a relative manner, in a related manner. That is relative valuation. Clear? Now, case study is given to you. Capital First Bank Limited. The bank is mid-sized Indian private bank. Now, it has its growing retail loan portfolio. It is evaluated for merger with large financial services group. For accurate corporate valuation, analysts applied both discounted and non-discounted. Now, the it is being evaluated what for a potential merger with whom with large financial services. And for this, both the methods, both the models have to be applied over here, discounted as well as non-discounted. Discounted cash flow will see the future cash flows for 5 years and it See, in discounting, we have different techniques. We do discounting with the help of dividend model also. We do discounting with the help of weighted average cost of capital, that is overall cost of capital. Okay. Now, and Gordon growth model. Gordon is a same dividend growth model. So with the help of WACC, terminal value is given what calculated using perpetual growth rate 4%, Gordon model and WACC 12%. Now, the discounted approach such as comparable companies analysis was used as benchmark against price to book value. So two values have been taken over here. One is price to be PB value and PE multiple. Now, these methods didn't capture aggressive growth. The strategic acquirer favored what discounted cash flow method because it is more forward-looking nature. Without discounting, you would not know the present value properly. So that is why discounting method is being followed in this merger. The deal was ultimately structured around the value groups. Have you read this? No. Related to, we have questions. In this case study, two values have been taken, that is price to book value and price to earning value. Now, price to book value is what? Price to earning value is your market price per share upon your EPS. And price to book value is what? Your MPS upon your book value. Now, in the DCF model used for Capital First Bank, the terminal value was derived using Gordon model. When the company uses the Gordon model for discounting, which key risk arises if growth rate is used in a model is overestimated? So what does the risk arise when we are overestimating this growth model? So it will lead to your increment in prices. Increment in prices means the inflation. That is overstatement of terminal value leading to inflated enterprises values. In capital first valuation, why might the DCF model be considered more appropriate than non-discounting? At last, what happened? At last, the company accepted what? The company favored the DCF approach. Why company favored the DCF approach? Because it is a forward-looking approach. It takes into consideration the future growth. So that is why the company adopted DCF. So DCF captures future growth and cash flow potential specific to the bank. See, it is a forward-looking nature despite its sensitivity to assumption, close to the DCF estimate. Because the without discounting method, the method does not capture capital growth properly. So that is why discounted was used so to analyze the future growth of the company. Next question, two more questions. Which valuation could directly affect both discount rate and the equity value? That is WACC, weighted average cost of capital. Now, question number 12. In the context of bank valuation, which of the following is the limitation of using non-discounted precedented transactions method? It excludes the terminal value if the discounting method is not followed. It pays to reflect the current market sentiments. It is based solely or internally, or it may not adjust for unique deal specific. Means it does not cater the specific needs or the synergies. Synergies is what? Synergies is that value of A company plus value of B company, the value of both the companies together will always be higher than the value of one company alone and the value of another company individual. If I say that the value of company A is 200 crore, the value of company B is 200 crore, so it is always more than when these two companies together work. That is 500 crore. Option B. Now, next, activity and function as in types of mergers are given. So you can consider this as A, B, C, and D. Read from the right side, the big one. Now, the two businesses that have recently merged, both operating in the same. When the companies are merging, two companies are merging in the same industry. Which type of merger is that? That is known as horizontal merger. This type of merger takes place when two organizations have buyer-seller relationship. Buyer-seller relationship means what? That is the one is supplying the goods, another one is buying the goods. One is supplying the raw materials, another one is making the finished products. That is the vertical merger. Now, the acquiring company and the company, it is merging, connected in some way. Either they will connect, they will produce their goods different region wise or demographic wise. So whether it is through fundamental technology, industrial methods, market segment, that is co-generated. And reverse merger is what? When any small company takes over the big company, or you can say that any company that is unlisted company acquires any listed company, big listed company. So in that case, reverse merger is there. So 1, 2, 3, 4. Option number clear. Now next, white knight. What is white knight? In the context of takeover defense. So there are defensive techniques for takeover. Like company A is there, company B is there. If company A wants to take the control of company B, but company B does not want to get merged in company A. So what company will do? Company B will take defensive measures, that is anti-takeover defense. Then that we have one method that is known as white knight. One technique is white knight. Now what is this white knight? A potential hostile acquirer, an independent third party sought by the target company to counter a hostile bidder. Means white knight is what? Just like you can say a friend who is helping you in your bad times. Just understand like this. A white knight is just like friend helping you in your worst time. That is white knight. So what is white knight? It is a friendly company that comes to rescue another company from being taken over by the hostile. See, there are two types of merger. One is the merger, both of them are agreed, and one is hostile merger. Means the target company is not agreed to get merged. That is hostile merger. So that is friendly companies there that will come to rescue your company. That is what? Okay, this one. When a company is about to be taken over by someone and they don't like, they may find another friendly company. That is the white knight company. So friendly company will come you and we will help you to buy them instead or better move favorable terms. Either that friendly company will buy you or that company will protect you from getting merged. Clear? Okay. Clear? So these are the two meaning of your white knight. And unwanted bidder is what? Unwanted bidder is known as the black knight. See, suppose company A is about to be taken over by company B. Company B is what? Hostile company. Now company does not want to get into company B. So what company C will come and that company C will help company A, okay, from the hostile takeover. Now conglomerate merger. What is conglomerate? Conglomerate merger is what? Like company A is there, company B is there. When company A, who is dealing in shoemaking company. Now, this shoemaking company is merging in the food and beverages company. So this is what? This is a type of conglomerate merger. When the companies are merging in an unrelated business, they are known as conglomerate merger. So merger between companies are different. Uh, sorry, option C is the answer. Between companies in unrelated business activities. Clear? Option B is not. Option C is the answer. Now, which of the following are features of financial services companies? So there are different types of companies. The valuation is to be done like financial services. Then we have companies related to distressed companies, the loss bearing companies, then real estate firms, startup firms. So what are the features of financial companies? And all this will come under special cases of valuation. So use of debt for earning income. Yes, this is the part of financial services. Financial services are heavily regulated sector. So regulatory bodies are there in financial sector companies. It is difficult to find the multiplier of these companies. You can say the multiples of companies. All of the above is the correct answer. Now, so it is use of debt for earning income, heavily regulated sector, difficulty in measuring reinvestment and difficulty in choice of finding multiples. Why? Because they have a lot of rules and regulations, protocols. They have to maintain what CAR ratio, Basel norms. So that is why these companies face such kind of problems. Now, next, which of the following entails dividing a large corporation, such as conglomerate? A large business is there. Now this business is dividing into multiple independent business. Multiple independent business this company is dividing. What is known as stock split, amalgamation, share buyback, or demerger. So that is when multiple independent business are made from one single entity, it is called demerger. That is option number D. Now, there are merger. Merger means combination of companies, and demerger means what? When you are splitting your companies, okay, in different units. So that is called demerger. So in demerger, we have different case components, like we have stock split, we have split up, equity carve out. Now, so amalgamation is what? When two companies are amalgamating to form entirely a new company. Company A and company B, they are together amalgamated to form a new company. That is known as company C. So this is what? Amalgamation. Now, stock split is what? Stock split is when you are breaking your shares, when you are breaking down your shares to make them cheap, to make them more cheaper. It is when a company divides its existing shares into more shares to make each share cheaper. Like suppose you have one share for company worth rupees 1,000. Now you are dividing that one share into its four parts. Means per share will cost now 250, 250, 250, 250. Or you are dividing into two for one stock split. Your one share becomes two shares. So, but the price of each share becomes 500. That is divided by 2. Simply, if you will divide by 4, your each share will be 250. Now, why this happens? Just to make the price affordable for investors, so that if their budget is low, then they can go for such type of purchasing of such type of shares. The low price, cheap shares. So value will be same, shares are more, and price per share will be less. Where the price per share was 1,000, now the price per share is 250. And the quantity of shares will be more, but value will be same. So this is stock split. Now, question number 18. You have to find the value using Gordon growth model. Again, dividend is given, growth rate is given, required rate of return is given. Required rate of return is also known as hurdle rate. So D1 is what? K minus T, or you can say required rate of return. D1 is what? 8 upon RE is what? Required rate of return is what? 0.09 minus 0.05. First, you have to find the expected dividend. Now, company PQR just paid a dividend of rupees 8 per share. Now, the current year dividend is given. Dividend yet to receive what is DO 1 plus C. Now, what is DO? 8 into 1 plus 0.05. Growth rate is 0.05. So, D1 is what? That is dividend you are yet to receive in the next year, coming year. That is 8.4. Now, 8.4 is your dividend D1. If you will put the value, you will get 210. 0.05, 0.09. Okay. Now, question number 20. XYZ Corporation, a tech startup, has been growing rapidly since its inception, with annual growth sales is above the industry level. Industry analysts they believe that this company will make the exceptional growth, but its growth has been slowed down by significantly after the next 3 years. So first the company has growth, then it slowly goes down, and then it maintained a stable growth. Now, which financial model would be most suitable for valuing XYZ corporation? First is what? That the company is making the exceptional growth, then it is slow down into the next 3 years, and then it will make what? The stable growth. Now this growth is what? That is stable. So which model says this? Dividend growth model, Gordon growth model, two-stage model, or capital asset pricing model? So that is two-stage growth model. Okay. So two-stage is also a little bit related to H model. So in H model is what? It also increases at the tremendous rate. The growth is there. Then it declines and then it maintains a stable growth. So that is GA and GN. Okay. Now, what is the difference between two-stage model and H model? So dividend discount model, it has two growth stages, and H model is what? Gradually it declines. It increases, then it gradually declines. So if it is increasing at the rate of 10%, then it will increase at the rate of 5%, and then it will gradually decline. 4%, 4%, like 3%, and then it will make the stable growth. So it starts with high growth. Growth is high, 10% is making, then it declines gradually, and then it makes what? At stable growth. Here is abnormal growth for few years, then stable growth after that. So like if company is growing at 20% for 5 years, after that 5 years, the company is stable at 5%. But in H model, company is growing at 10%, yeah, 15%, then it reduces slowly and then it maintains at stable rate. So that is the difference between two growth model and two-stage model and H model. Done? Now, next question. What is one of the key requirements for accounting for business combination under acquisition method explained in Ind AS 103 and ICAR? Determining the fair value in AS 103, recognizing and measuring identifiable assets, acquired liabilities. See, in acquisition method, you have to measure and recognize the assets acquired and the liabilities which you have been assumed. So option B. So B is correct answer. Now, question number 22. It is based on the case study of Kodak. There was case study. The case studies are very important. Kodak, IBM, and one was the printing the printers. Okay, that was the case study. I'm not remembering the name, but it is based on the printers. Xerox. Suppose you are a business consultant and you want to use the Kodak case as an example to highlight the adapting to technological and market changes. Now, what lesson you have learned from Kodak cases? Why Kodak case failed? The biggest competitor of Kodak case was at that time was Fujifilms. Now, Fujifilm was busy in making what? In making the more digital camera, the enhancement in its digital camera. Whereas on the other hand, Kodak was busy in acquiring Fujifilms. So that it does not study the market properly. So Kodak focused on traditional film photography. It was successful. It was successful on traditional film. No. Kodak management was quick to adapt emerging technology. Did Kodak adapted technology or Fujifilms adapted technology? Tell me. Kodak was making the plans, plotting everything. Kodak was busy in acquiring this company. And this is also not The Kodak failure to embrace digital photography and adapt to market trend resulted in its decline. Yes. Till the time when Kodak realized that now I have to improve my market, I have to improvise my camera. At that time, what happens? The market trend was changed completely and their workforce get reduced. So if the company is not working properly, then they have to do the reduction in their workforce. Option C is the correct answer. Clear? So these are all the reasons why Kodak failed. Now, question number 23. If two companies have identical PE ratios, price to earning ratios, but one has higher PB ratio, so what you can conclude from this? PE ratio is what? MPS upon EPS. And price to book value, MPS upon B book value. So company with higher PB ratio is undervalued. If its price to book value is higher, it is undervalued. No. The company with PB ratio has more debt. If the company is taking the book value, if company is considering the book value, does not mean that it is having the more debt. The company with higher PB ratio has higher return on equity. Yes. The book value is higher. It means it has return on equity higher. So that is option number C. Clear? See, companies, they are having the same PE ratio. Okay, if company A and company B, they both are having like, let's take an example 40-40. So they both are having the same PE ratio. But if one company is having the higher PB ratio, so it means the company who is having the higher PB ratio, it will have return on equity higher. Okay, from equity shareholders, what is the value of your shares in the market? That is ROE. Okay, what return you have earned from your equity shareholders? Option C. Now, two statements are given to you. In an amalgamation in the nature of merger, accounting is done using the pooling of interest method. Yes, this is one of the method. What is pooling of interest method? Again, it is simple way of combining two companies during a merger. Now, in this method, both companies will take the value of assets and liabilities at their original book value. Means whatever in their balance sheet the value is mentioned, they will take the book value. In pooling of interest method, asset and liabilities of the transferor company recorded at their fair value. Is it fair value or is it book value? It is book value. So that is why this statement is wrong and only one statement is correct. Now, next question. Now, for doing the overseas project, RBI has issued guidelines that restrict Indian banks from financing the acquisition of equity shares. Now, which of the following statement is correct? Indian exchange control restrictions finding for inbound acquisition cannot be secured by pledging shares of the Indian target. Now, Indian, if any overseas company, okay, they want to invest in India, so they have to follow certain rules and guidelines of our India also. Now, when they are investing in India, so they cannot take money, they cannot take help from our own regulatory body, that is RBI, or our own, you can say, commercial banks. Indian are allowed, but not the foreign people are allowed. Foreign countries, you can say the companies, they are allowed. Now, and they cannot give, they cannot take the, you can say the loan against of the securities, or you can say shares. Indian exchange control restriction, financing for inbound acquisitions are not allowed for this. Now, Indian banks, financial institution cannot provide loan to offshore. Yes, Indian bank or any Indian financial institution, they will not going to provide any kind of offshore organization. Financial FPIs, foreign portfolio investors are required to obtain registration from SEBI in accordance with the SEBI Regulation Act, and foreign owned and controlled operating companies, that is C. The foreign companies, they can take the help from FOCCS. They are permitted to leverage in the Indian market for acquiring shares. When any company is acquiring the shares of the Indian market, these companies will help. This is the correct answer. No Indian bank will help to the offshore companies, but the FOCCS, they can help the foreign companies for acquiring shares in our Indian market. Clear? Done? Option D is correct answer. Now, which of the following statements is correct? Reverse merger is what? A merger, smaller company acquires still smaller company? No. A smaller company acquires larger company? Yes. Or any unlisted company, they will acquire the listed company. Now, you have to find PE multiple, price to earn. See, already the formula is given, and I have given the question also. See, VNS company's return on equity is 20% and its R is what? 15%. Now, dividend payout, see, there are two type of ratios. One is dividend payout ratio and second is retention ratio. Now, can anybody tell me what is dividend payout ratio and what is retention ratio? And what is the formula of dividend payout and retention ratio? Okay, Manoj ji, you are giving the answer of which question? Please mention the question number before that. Tell me the dividend payout ratio and retention ratio. What is the difference between these two? See, when company makes the profit, now how company makes the profit? Sales are there minus variable cost, contribution minus fixed cost, EBIT minus interest, EBT, or you can say PBT minus tax, EAT, or profit after tax. Now, when this earning after tax or profit after tax comes, what you do? You will pay off all your liabilities, all your debts. After that, whatever amount is left, that amount you will going to pay as dividend to your shareholders. Tell me, will you do or not? Yes. Now, this dividend, when you pay to your shareholders, it is known as a dividend payout ratio. At what ratio you are paying to your shareholders, dividend payout ratio. And if you have kept that amount for reserves and surplus, for provisions, for internal as internal accruals, that ratio is known as what? Your retention ratio. Clear? What is dividend payout ratio and what is retention ratio? Clear? Now, retention ratio, that is RR, it is denoted by B. Now, tell me, if whole is denoted by B, then how you will denote your dividend payout ratio? Payout, dividend payout, or sometimes it is written payout ratio. It will be 1 minus B. If your retention ratio is B, then your payout ratio is 1 minus B. Clear? Now, return on equity is 20%. R is what? It is cost of equity. Sometimes it is written R minus D or K minus D in dividend model. That is cost of equity. And company's dividend payout ratio is 0.3. So retention ratio is how much? Retention ratio would be 0.7. Retention ratio is what? 0.7. Now, what is the formula of PE multiple? This is the formula of PE multiple. Price to earning ratio. Clear? And retention ratio, the another name of retention ratio is what? It is also known as plug back ratio. Clear? Yes, correct. It is answer B of question number 26. Now, this is the formula 1 minus B. 1 minus B is what given to you? That is 0.3 payout ratio. R is cost of equity 0.15, we can write, minus return on equity 0.20, ROE into B. B is what? That is your retention ratio 0.7. So if you will calculate, you will get PE multiple is what? 30. And this multiple we will use for purchasing the company which we want to purchase. Like, okay, why we use multiples? Why we use multiples? Suppose you are purchaser, you want to purchase any company. Okay, this is the seller. This company XYZ Company Limited, and you are the purchaser. You have your company ABC Limited. Now, if you want to purchase this company XYZ, so you will do the valuation. But what if you cannot find the actual valuation of this company? So what you will do? You will find the similar type of companies in your nearby location. The companies whose working condition, the culture, everything is same to this company, XYZ company. After that, you will find the multiple of these companies, and whatever multiple of these companies will come, you will apply the multiple to this company. Like multiple comes 10 times, like comes 20 times. Now you will ask, the purchaser will ask from the seller that what is the EBITDA of your company? Tell me. If the seller will say that it is 50, let's take an example, it is 50 lakh. Then you will use the multiple. Suppose that multiple comes 10 times. So you will take 10 times of multiple of this company and you will find the actual valuation of this company, that is 500 lakh. So likewise, we use multiples to take that value in order to purchase the company. This is the formula done. P multiple. Then similarly, we have what? We have EBITDA. Some will take the P multiple, some will take the enterprise value, some will take the EBITDA value. Now, what is the formula of EV upon EBITDA? ROIC is given what? 20%. ROIC is what? 20%. Then G is what? G is 11%. So 11% is what? Your growth rate. So can we write 11% as 0.11? We can write now. Depreciation and amortization is given how much? 9%. Tax rate is given 30%. Now, what is the formula? ROIC minus growth into 1 minus DA into 1 minus D. Simply, if you will put all the values in this formula, you will get 14.33. Done. And these are when we have to do the valuation without following discounting. Means that is non-DCF valuation. Now, similarly, if I want to value your company with the help of EBIT, earning before interest and tax, what is the formula? 1 minus the tax rate is given 30%. We can write 0.3 tax rate. Reinvestment rate, what I have earned, I'm reinvesting in the same rate only, that is 0.7. Then WACC is given 15% weighted average cost of capital. In weighted average cost of capital, your cost of equity is there, your cost of debt is there, your overall cost of capital is there. And growth is what? 12%. So we can write 0.12. Now, see, if you are valuing, if you are taking the enterprise valuation multiples model, you have different types of multiple model. You have EB upon EBITDA. Then you can do the valuation with the help of EV upon EBIT. Then EV upon book value. Then we have EV upon sales multiple. So these are all our multiples. Then EV upon free cash flow to firm. FCFF is that free cash flow to firm. Whatever cash, free cash flow to firm. The cash which is available to the firm, that is FCF. So all these are the multiples. Now, how to calculate EV upon EBIT? So this is what? This is the formula. WACC minus growth rate. Simply all the values are given. You have to put all the values in this formula. So 1 minus 3, 1 minus 0.3 into 1 minus 0.7. 0.15 minus 0.1. If you will calculate, you will be getting 7. Done. So EV upon EBIT is what? This ratio is defined as enterprise ratio upon earnings before interest and taxes. And earnings before interest and tax is earning from what? From your operating assets. But before tax. So we can write one formula, that is EV upon EBIT 1 minus tax rate. Now, next is given, if book value is given to you, how you will find the multiples with the help of book value? ROIC is given, return on invested capital 18%, growth is given 11%, and weighted average cost of capital given 13%. Simply, this is the formula. So you can write 0.18, ROIC is 18, 0.18 minus growth is 0.11 upon WACC. WACC is 0.13. Again minus growth rate is 0.11. Okay. Now, next question. Question number 31. Which of the following best describes the carve out in the context of divestitures? Selling subsidiary or business unit to a competitor, creating a separate public traded entity from division of parent company, merging the subsidiary with another company, or closing down the subsidiary. So what are divestitures? Divestitures are just your demerger. Now, carve out is what? Creating a separate company from a division of your parent company. You have your parent company or a holding company. Now, from this parent company, you are dividing a division. Okay, you are taking out this division and you are forming the company that is called subsidiary company. Or you can say that another parent company. Although it's a part of the parent company, but you are creating a separate entity from this holding company. So that is known as carve out. Now, we have different types of demergers or divestitures. Spin off, split up, equity carve out, and divestitures. Now, what is the difference between these two? Now, there is one word, one is spin off and one is split off. See, one is spin off and one is split off. Now, split off is what? It is the one type of demerger. And what happens in this? In this, the shareholders, they have the opportunity to either, if the company is dividing, like parent company is dividing into its one division small part. Now, in this, the shareholders, they have the opportunity to either they can keep shares of the parent company only, or they can take the shares of the newly formed companies. Means they have the option. They can take the shares of parent company or they can take the shares of the subsidiary company. They have opportunity to either they can keep shares of parent company or newly formed company. This is split up. And what is spin off? Spin off is what? Where a new independent company is created. New independent company is created from existing parent company, where old shareholders, they have to receive shares in entirely new company. Here the shareholders have the option. They can take the shares either from parent or subsidiary. But in spin-off, a new company is created from parent company and shareholders are allowed only to take shares of this newly formed company. That is spin. Clear? Understood? See, this type of demerger involves division of company into wholly owned subsidiary parent company by distributing all its shares of the subsidiary company on pro rata basis. Now, split off is clear to you? Now, what is split up? So, spin off is again entirely new and separate independent companies formed from a parent company, and the parent company shut down, and the newly independent company, the shareholders, they have the shares of this company. Now, what is split up? Split up is what? When parent company shut down, when from parent company, two more companies are made. From parent company, only one new independent entity is created. But in split up, two, three, four, more than two, three independent companies are created. That is called split up. So you have to learn the differences between spin off, split up, then equity carve out, divestitures. These are the demergers. Because in exam they will ask the question from different types. So the clarity should be there. If you are having doubt, then ask me again in all these terms. Clear? Any doubt in these four? Now, so spin-off is what a part of the company becomes a separate new company, and existing shareholders have given the shares of what the parent company in the entirely new company. That is what the spin-off. Now, split off is what a part of the company, it becomes a separate company. That is split off. And shareholders who exchange the shares, their shares of the parent company, they can take the shares in the parent company also. They have the option, and they can take the shares in the newly formed companies also. The split off and spin off. Now, split up, one parent company is there, two, three companies are being formed, entirely a new independent company, and the existing shareholders, they will get the shares in the new company, and the parent company will shut down its operation. The original company stops existing. So like company A is there, company A becomes company B and C, and company A no longer exists. Clear? Now what is equity carve out? Again, a small part of the business is made to a new company. So share of my, like, if I say that I have my company, the share of my subsidiary company rather than my parent company, and the shares are being sold to IPO, not necessary to their existing shareholders. So in equity carve out, what happens that I take money from you by selling the share of my subsidiary company rather than my private company, and the shares of my new company, they are sold at IPO, not to my existing shareholders. That is equity carve out. Split up, parent company is there, two, three independent companies are formed, and the parent company is what shut down. Now, spin off is what? Now, from parent company, its part becomes a separate new company. Like if company A has two business, phones and laptops, it makes laptops. Laptops is entirely new company. Now we can take the shares in the newly independent company. Understood all the terms? So this is spin-off, new company is formed. New company formed, only those who exchange old shares, their existing shareholders. Split up, entire company breaks into new ones. Old company's existence completely lost, and existing shareholders will take the shares in the new company. Equity carve out, new company is formed through shares are given at IPO, and it is sold to public investors, that is initial public offering. Clear? Sure. Now next question. Question number 30. What is the significance of Section 72A of the Income Tax Act in case of amalgamation? What is the benefit in amalgamation, in the context of amalgamation the company gets? The tax benefit. So they're allowed for the carry forward and set off their all accumulated losses. If the company has made any kind of loss, then they are given chance then that they can set off their loss and they can carry forward their loss, but only to an Indian amalgamated company. Option number A. Now next, 33. Under Section 72A, for how many years can amalgamated companies they can carry forward and set off their losses and unabsorbed depreciation? Five years, 8 years, 10 years, or 15 years? That is 8 years. Clear? Now this corporate restructuring. Restructuring means completely changing the pattern of the company. The process of reorganizing a company structure, their pattern, their operation, their policies, finances to improve efficiency. Now next. If a parent company owns 80% of the voting shares in subsidiary company, parent company is there. Now, if the parent company has its subsidiary company and in the subsidiary company, 80% of the voting shares are under the parent company. How are the remaining 20 non-controlling interests typically treated in consolidated financial statement? Rest of the 20%, how they will be treated? Parent company is controlling only 80% of the company. Rest 20% is included as, it is treated as, yes, it's B, correct. Rest 20% is, they are excluded from equity? No, because they are the part of the company. How we can exclude? Included in liabilities, or they are included as a separate component of equity. Option number C. Now, 36. Which of the following is a valid reason to prepare consolidated financial statements? To present tax neutral income, to show the combined financial position. Why consolidated? Is there are one is separate valuation and consolidated valuation. So they are consolidated means a combination of two companies, combination of two companies financial statement to show the combined financial position and performance of a group as a single company. Like if parent company is there, under this parent company's three subsidiary companies is there. Now, if you will show separate balance sheet, it will take a lot of time to understand also to see also. So rather than making the separate, let's make one consolidated balance sheet so that it is easy for everyone to understand. That is performance of the group as a single economic entity. Now next, 37. Investor analyzes company that is not paying the regular dividends, but it is generating its cash flows by meeting uh, by meeting all its debt obligations reinvestment thing. Now, the investor chooses a model that discounts these residual cash flow at the cost of equity to determine the intrinsic value of the companies. They are not giving regular dividends to their shareholders, but the company is paying the obligation, the debt obligation, and the company is keeping some money for its reinvestment need. Now, which model is fit for this scenario? The company chooses what that they will discount these residual cash flows at cost of equity. So for cost of equity, which type of model we have? Which type of model do we consider for cost of equity? Dividend discount, FC, FE, FCFF, or economic value added. For cost of equity, we consider free cash flow to equity model. Option number B. Now, question number 38. Why B in which this one? You're asking about this question? Tell me. See, if you're asking about this question, see, the question says that if you will read from here to here, the investor chooses model that discount these residual cash flows. Residual cash flows means what? The cash flows, which are left for the company after paying all your liabilities and all your debts. That is the residual value. But from this residual value, you're not paying the dividends to your shareholder. You are using that money for your cost of equity. Cost of equity is what? Your cost, your equity shareholders. So that their intrinsic value is how intrinsic value of a company is measured with its equity shareholders, with its owners capital only. Na? That is why free cash flow to equity model, this represents the cost of equity. Now it is clear to you. So, have you studied different approaches? Different approaches. There are three types of patterns. The growth pattern, pattern 1, stage 2, stage 3. So in that, okay, understood. In that we have FCFF and FCFE. Clear. Now yes, this one. Question number 38. Dividend 5 per share. Dividend are expected to growth is given constant rate 6% and required rate of return is given. Everything is given. Now you have to compute the dividend growth model, the dividend discount model. Tell me the answer. First, you have to find the D1. The value of DU is given. You have to find the value of D1. Then in that D1, R minus G. Can you compute this? So 5 into 1.06. R is what? 0.11 minus growth is 0.06. Now, tell me what is the answer. So 5 into 1.06, 5.3, 5.30 upon 0.05. That is 106. Have you got this answer? Okay, so 106 is the answer. Now, similar type of question is this one also. Equity shares are currently selling for 80 each. Last dividend paid was 8 per share and company follows a zero growth policy. Now you have to understand that over here the zero growth policy is being followed. Now what is the formula of this zero growth model? Zero growth model. D upon P, or you can say the K, that is zero growth model. Yes. So 8 upon 0.10, that will be your 80. Understood? Required rate of return. And this 8. Now, so this is all the explanation for your previous two questions. Now, next question number 40. Enterprise value indicates or it includes. So it includes market capitalization, debt, minority interest, and net operating interest. So all of the above is the correct answer. Now, following statements about valuation approaches are correct. The market approach uses comparable transaction data. Yes, market approach, you will use the comparable approach. You will compare the companies. Cost approach uses replacement or a production cost. Correct. Income approach is discount cash flow to the present. Yes, we use discounted cash flow technique. Book value approach is a part of the income approach. Is it so? Is book value is a part of the income approach or your book value approach? So 1, 2, 3 are correct, but 4 is wrong. Option number A. The book value is a part of the income approach. That is incorrect. It is based on the value of your assets and liabilities from balance sheet. So it is more related to cost or asset based approach. I guess we have done this question. No? Yes, we have done this question. Yes. Now, next case study question. Zenith Bank Limited, top tier Indian private sector bank, is faced declining. Multi-phase mergers, phase 1 horizontal, phase 2 vertical, and phase 3 conglomerate. So in horizontal merger, it merged with Apex Urban Bank, which operated in the same retail banking space in Tier 2 and Tier 3 cities in the same geographical area to enhance more area. Now, in vertical merger, Zenith acquired chain link payment services vertically. A backend payments settlement system is there for better data security. Now, conglomerate is what it merged with Shield Life Insurance, a standalone insurance firm with no prior synergy. Means unrelated business they are merging together. So each phase is approved after rigorous due diligence. Due diligence means all the compliances and the guidelines is being followed. Then only this company is approved to merge. Clear? Now, should I show you the questions? These are the questions. Which potential risk is more specific to the conglomerate merger undertaken in phase 3? Dilution of market share, reduction of operational efficiency, misalignment of core competencies and strategic focus, or redundant overlap in customer bases. So conglomerate, if it is merging in unrelated business, why? When no prior synergy is there, so there is more chance of misalignment of their core competencies. From regulatory standpoint, which merger phase is most likely to attract attention from CCI? The horizontal, vertical, or conglomerate. See, most likely to attract. Why? Because of potential market dominance. So, how one can dominate the other market when they both are working in the same industry? So that is horizontal merger. 45. Acquired a competitor in distress with the intention to use its tax losses and quickly expand. So when Zenith Bank has acquired the competitor, now that competitor is in the distress state, means not making huge profit with the intention of what? With the intention of use its tax losses. So if the Zenith Bank will use the distress firm, they will acquire the distress firm, then what will happen? Their tax liability will be less. They have to pay less tax to the government. So what type of merger is this? This is reverse merger. Now, post phase 2, Zenith gained full control over its payment system. What advantage is there using its payment settlement system? So the advantage of value chain integration for cost and control. 47. Overall multi-phase approach, Zenith Bank strategy can be categorized under which of the following merger motives? Multi-phase approach. to increase its bank competencies, that is platform consolidation and vertical scale. Now, what is leveraged buyout? Leveraged means what? If you talk about the leverage, it means what? Debt. Debt means what? Loan. If you are purchasing another company with the help of loan, that is known as leveraged buyout. So target company's dividend payouts history, target company's current stock price or availability of collateral for securing debt financing. Now, next two questions, 49, 50. Which of the following valuation method is most appropriate for startup company with negative earnings? Which type of method you will follow? Price to earning, discounted, market capitalization, or revenue multiples? Option D, revenue multiples. Now, adjusted present value. Just now, in the morning, we have done this adjusted present value, that you have to adjust your present value. And this present value is adjusted with the help of probabilities. Probabilities are given to you over the traditional discounted cash flow. Which of the following best explains the reason behind the adjusted present value over traditional DCF? Why we use adjusted present value? Just for the tax shield benefit of debt separately, it provides a clear picture of the value of the firm. That is why if the probabilities are there, it means that if in the first year you are receiving 35,000, the net present value you have to calculate. In first year you are receiving 35,000. Now, what is the probability that in first year you will going to receive 35,000? The probability is, let's take an example, 90%. Now, this 90% is the probability. So, actual, what is the 90% of 35,000? So, your 31500. This will be your cash flow after adjustments. Now, next case study questions. Nexa Financial Bank Limited, a rapidly growing private sector bank, it is evaluated for its long-term equity. And which type of valuation this bank considers? That is price to earning ratio model. Now, what is price to earning? Price to earning, that is MPS upon EPS. How we can take the multiple price to earning? Suppose two companies are there, X Limited and Y Limited. Now, X Limited is the comparable company, okay, and Y, let's say X is the competitor company of Y, and you have to purchase company by Y, but you cannot get its proper valuation, so you are finding the similar type of company, now its competitor. So company is having the market price per share, let's say 100 per share. Then EPS value of one share, let's say 10. Now, what is the price to earning multiple? So 100 upon 10, that is 10 times. Suppose the value, the EPS per share The Y is having the value rupees 20 per share. EPS is 20. Now 20 into 10, that is 200 MPS. MPS will come 200. So in this way, you have find the value of MPS. Now you will apply what in the Y. So once you get to know the multiple of the competitor company, then you can easily apply that multiple to the company which you want to purchase. So Y is what? The MPS is 200 and EPS is what? That is 20. So MPS upon EPS. So now this company is having its multiple 20 times. So in this way, you will find the PE multiple of the company. Now, next the financial reports, EPS of rupees 28 and trade at PE ratio of 22. Market price is what? Comparing these to the market prices 616 per share. And banks, they are working in the same peer segment. So their PE multiple is what? Between 16 to 80. Now, next the financial report has PE 22, but the Axis Bank and Kotak Mahindra, they have their multiple 16 and 80. So further, what analysis is that the companies having the peer companies, they are having the higher value, okay, 18 and 13, and PE ratio is what? That is 22. It is having the higher value. Earnings has averaged to 21 annually for the last 3 years. The growth rate, the average growth rate is for 21%. Now, despite these positivities of Nexa Financial Bank, it may reflect growth expectation already priced in the stock, and some will recommend that PEG ratio is more realistic than the PE ratio. Now, based on this case study, we have few questions. Now, based on Nexa Financial PE ratio 22 and EPS 28, which of the following is true? So stock was undervalued in this case compared to its peers, or it is overvalued. The companies were having 16 and 18. It was higher. Market will expect higher future earnings growth when they are having the higher PE ratio and EPS. Now, next, the financial ROE is much higher than peers, which relationship best explains the impact of higher ROE on PE. So, if return on equity is higher, what does it mean? That the value of equities is also higher. Their PE ratio is also higher. So higher ROE improves net margin, but no impact on PE. No. If ROE is higher, then PE will be impacted. Higher ROE justifies a higher PE due to better returns on shareholders. That is option number C. Now, 53, 54. High PE is primarily driven by future growth expectation. Which valuation metric offers a more balanced view by adjusting actual growth rates? Now, what is the reason behind this? So in case study, if you will see what it says, that what gives you the more realistic picture, that is the PEG ratio will give you the more realistic picture. '54. Again, one case study is given from the question. It is asked that suppose Nexa Financial misses its project earning estimate next year. Now, how it would affect on its stock price if still it is having the current PE ratio? So if you are having like current PE ratio is your 22, but you cannot analyze your you can say the future earnings next year. So what will happen? It has the significant decline as overvaluation gets corrected. Now, last question. In comparing next of financial valuation using PE ratio versus DCF. DCF is what? That is finding your present value, analyzing all your future elements. Which of the following limitation is there with respect to PE model? So if you're not taking the consideration DCF means you are taking non-discounting method, and non-discounting method is what? That you are not considering time value of money. If you're not considering time value of money, it means it does not capture your future cash flow timing or risk adjustment. Option C is the correct answer. Yes, so we have completed module C MCQs. Any doubt in any question? Any doubt? Then tomorrow we'll have last module, that is module D. In the morning also we are having session from 7 to 9 a.m. Capsule batch lecture 6, and evening 7 p.m. to 9 for our module D. So let's meet tomorrow. And yes, the PDF will be uploaded. So don't worry about the PDF. Once the session gets end, I will upload the PDF immediately. And I will upload the answers marked PDF. So it will be beneficial for you to revise. So let's meet tomorrow. Till then, take care, everyone. Goodbye. And if you are new to this channel, please subscribe the channel because we are having our BRBL sessions also, then our elective paper sessions also in English medium. Yes, elective paper will be in Hindi medium in the Hindi channel, the Oliveboard JAIIB CAIIB, but you are having our BRBL sessions in English only. So let's meet tomorrow. Till then, everyone, goodbye.